Hi, everyone. We're going to take a look at a few problems in Chapter 9. I just want to verify something really quick. I meant to before I got on this. Okay, excellent. So we're going to take a look at P9-1, P9-3. I'd like to take a look at that one, although it's not on your assignment list, and P9-9. So let's get started. In P9-1, Decker Company has 5 products in its inventory. Information about the December 31st, 2021 inventory follows. The cost to sell for each product consists of a 15% sales commission. We need to determine the carrying value of inventory. So at what value will our inventory be at on December 31st, assuming the lower of cost or net realizable value rule applies to each individual product. So these are the rules that were discussed on pages 460. And remember, companies that use FIFO and average cost use this method at the end of the year. LIFO will be, those who use LIFO should use the rules of lower of cost or market that we'll talk about in P9-3. So if we take a look, product A, they give us the number of items there are and the unit cost and the selling price. So that's where these 10,000 and 13,600 came from. So for product A, there were 1,000. They each cost $10 each, so $10,000. The net realizable value is calculated by taking selling price minus the costs of any selling. So in this case, since there's a commission of 15% of the selling price, we need to subtract from that 15% of $16. So the net realizable value is $13.60 a unit times 1,000 in the quantity, 13,600. It's the lower of the two amounts for product A that will be the ultimate ending value in inventory, 10,000. Take a look at B. They paid I'm not sure if they did $15 a unit, and there's 800 units. So the total cost of all 800 are 12,000. The selling price is $18. So take 15% of $18 and subtract it from $18. If you wanted a one-step way of getting to the $15.30, the net realizable value is 15% less, okay? So we subtract 15% of the selling price from the selling price. Well, if you convert that and go, well, 85% of $18 is the net realizable value because we subtract 15% of it. So take 85% of $18 and you come right to the $15.30. So multiply that by the 800 units. Be careful of that. 12,240 is the net realizable value. The lower of these two would be the $12,000. So far the cost has been the lower. Take a look at C. In C, each one costs $3, 600 of them, some 1,800 is the cost. They sell for 8. So if you take 8 times 85%, $6.80 is the net realizable value times 600 gives us 4,080. So still the cost is the lower of the two. But in part D, they cost $7 each. There's 200 of them. 1,400 is your cost. Then the net realizable value would be $6 times 85% or $5.10 times 200, 1,020. So the lower would be the net realizable value. The same occurs for E. 600 times the cost of 14 gives us 8,400 total. They sell for 13. So the net realizable value, remember, you have to subtract out that selling expense. 15% of 13, 1,105. 1105 times 600 or 6630. So in that case, the net realizable value will be the value of the inventory at the end of the year. So if we do this on an individual basis, add up the lower of cost or net realizable value per unit, total inventory should be at $31,450. Remember, when we buy inventory, we increase the inventory account. So right now its value is at $33,600. So we would need to make a journal entry at the end of the year to write that down. And we'll be seeing that in part 3. Part 2 says, well, what if instead we applied the rule on the entire inventory? Which one would win? Well, the entire cost of the inventory is $33,600. The entire net realizable value is $37,570. So the lower amount would be $33,600. So there would be no changes. The cost is the lower of the two, so we wouldn't need to do anything. In part 3, it says, what kind of an adjusting journal entry would be required if we used requirement 2's method? And the answer is none, because the cost was the lower. But let's assume instead we use requirement 1. What would be the journal entry? Well, you have some choices there. Sorry, I didn't check this out in your book. Shame on me. But the journal entry, yeah, cost of goods sold. Okay, and there are some other, okay. So on page 462, you would debit cost of goods sold for the difference between the cost of $33,600, where the balance currently stands in inventory, and where it should stand, $31,450. So if I take the difference, I'm going to debit cost of goods sold $21.50 and credit the inventory account $21.50. Okay, so that's how we get it to the balance it needs to be at because of this analysis. Now in problem 9.3, sorry if you heard that. My phone's going off. I don't know why. I guess not then. Okay. In problem 9.3, a little different approach because of the method we're using. And actually, when I was in college, this was the only approach we could use. It's called the lower of cost or market value. Now, remember, when we say market, we don't mean selling price. We mean normally replacement cost. Now, we get even nitty gritty and more detailed here because we're basing our market on how much we can actually sell it for. Okay, now in here we have Forrester Company. They have 5 products and there's information about their inventory at the end of 2021. Make sure you read all these writings here. The cost to sell for each product consists of a 15% sales commission, similar to what we saw before. And their normal profit for each product is 40% of the selling price. So be careful of that. Now, in this type of analysis, we look at replacement cost, which they give us. They give us the cost, the original cost of each item. Now, back in Accounting 111, we said just compare those two, and the lower amount is the one that you'll value the inventory at the end of the year. But because we don't want to value inventory too low or too high, we use what's called a ceiling and floor structure or analysis so that we don't make our replacement cost too low or too high. Floor, or the lowest your market can be, floor is your net realizable value. Remember what net realizable value is, just like before. Selling price minus cost of sales. In this case, the sales commission. But we've taken a step further and subtract the normal profit. So the lowest our replacement cost can be, market, is the floor. The highest the replacement cost can be is the ceiling, which would be net realizable value. So I know when I was learning this, I was like, what? What do you mean? If it freaks you out too much, once you get those two calculations, take the one that goes in the middle. Whichever one, if you put them in descending order, the one in the middle is the one you want to use. Okay, and that way your replacement cost or market will never be higher than ceiling or less than floor. And that's how you could think of ceiling and floor being a room. And that if your replacement cost falls between them, then replacement cost is your market. If your replacement cost is above the ceiling, can't have that. That means your market is the ceiling. If your replacement cost falls below floor, can't have that either. Your market will be the floor. So let's take a look here. For the first product, we have 1,000, they cost 10 grand or $10 each. So there's the $10,000 right here. Now, when we're doing our market analysis, we start with our replacement cost. Replacement cost is how much this company, Forrester, can buy this from their supplier right now at the end of the year. 1,000 of them they have in stock, so $12,000 is the replacement cost. Net realizable value will be the $16 selling price minus 15% of $16, and that's right here. Okay, or you could take 85% of 16, and it's $1,360. So the highest your replacement cost can be is $13,600. The lowest, or if you want to, if you don't want to say replacement cost, you could say market. So if that replacement cost, this 12 grand was above, if it was more than 13,600, we would use 13,600 as our market. It's not. Replacement cost cannot be below our floor. Now take our 13,600 minus 40% of $16. Okay, so we get 720 if we subtract 1360 minus 40% of the selling price, not net realizable value, but the selling price. 720 times 1,000. So the lowest our replacement cost can be, or market, is 7,200. So if we went 13,600, 12,000, 7,200, our market is the 12,000. After all that analysis, we compare the market to the cost, and the lower of the two, the cost, is the ultimate value. But that will change as we go through. So let's take a look at the next one. You have 800. They cost $15 each for a total cost of 12,000. So there's our cost. Let's find our market. Our replacement cost right now is $11, 8,800. Net realizable value is selling price of 18. Subtract your commission, 15% of 18, $15.30 times 800 will give us 12,240. Now subtract 40% of selling price for your net realizable, from your net realizable value. So per unit, it would be $8.10 times 800, $64.80. So the highest your market could be is 12,240. The lowest, $64.80. Replacement cost falls in between. It's like in the room, if you want to look at it that way. So your market is 8,800. Now, in this case, your cost is above market. So market is the amount. Take a look at C. $3 is your unit cost times 600. We get 1,800 over here in this column right here. Replacement cost is $2 each, so 1,200. Net realizable value, selling price is 8 minus that selling commission times times 600, 4,080. Net realizable value minus normal profit. Okay, so oops, I'm in the wrong one. So per unit, $6.80 is your net realizable value. Subtract 40% of your selling price. So $3.60. Now take a look at this. So the highest your market could be is 4,080. The lowest is 2,160. Replacement cost falls below the floor. So the floor is your market. Compare the two, cost still wins. It's the lower of even after all of that. So that's how that works with that ceiling and that floor. Take a look at D. You have 200. They cost $7 each. So there's your 1,400 total. Replacement cost is $4, so 800. Net realizable value, $6 minus that commission times 200 will give you 1,020. Subtract your normal profit, 40%. Here it is down here, 40% of $6. Subtract that from your net realizable value of 510. Then multiply that by the number of units. So in this case, your replacement cost is the middle number, falls between the ceiling and the floor. So that is your market, and that will be your final value. Last one. Here, our replacement cost is, so you guys know how to get cost now, right? Our replacement cost is 600 units times 12, 7,200. Net realizable value, selling price is 13, subtract that sales commission, 1,105 times 600 will give us 6,630. Subtract your normal profit, 40% of $13 from the 1,105 to get 585 times 600 gives you 3,510. Now take a look. Your ceiling is 6,630. Since replacement cost is above ceiling, ceiling is your market. So like I said, put them in descending order, and you always use the middle number and you'll get to it. That is the lower. Market is lower than cost. So the value of the inventory is 6,630. So if we did this on an individual basis, right now our inventory has a debit balance of 33,600. It needs to be written down, just like we did before, using that journal entry to 28,030. Okay, so I just wanted to go over that with you, and just so you have a review of that type of situation. Problem 9-9, retail inventory method. Oh, don't we love this? I never liked it when I was learning it. Now I'm like, oh, I love this. You guys are probably there. Shut up. Okay, let's take a look. SmithKline Company maintains inventory records at selling prices as well as at cost. For 2021, the records indicate the following data. Now remember, these are retail stores that can use this method for determining a quick inventory balance. Now, when we use this method, we have to maintain records of the cost and the retail. Something else we have to maintain and keep track of are when we first start selling or pricing our goods, that's our first retail amount, okay? A markup occurs when we increase the price from that original selling price. So let's say it's Christmas time and all of a sudden all this one item starts selling and we don't have a lot in supply. We may have to raise the retail price of it from its original selling price. That's a markup. And when we decrease the price down to its original selling price, that's a markup cancellation. Now, if we decrease the price from its original selling price, that's a markdown. And then it would be a markup cancellation if we increase the price back to its original selling price. So just a quick review there. They give us information about beginning inventory at cost and retail, the purchases during the year, freight in on the purchases. Remember, freight costs are added to the cost of the inventory. And if you're saying, well, why isn't there a retail amount there? Because that's already figured in to the selling price of the goods. Purchase returns. So we would subtract any purchases that were returned at cost and retail. And then they give us the markups, markdowns, and the net sales. Now, under the first method, average cost, we keep track. We use And this one is demonstrated. The difference between all of the methods is how we come up with the cost to retail percentage. So average cost is on, oops, there it is, 472. And when we use the average cost method, we add markups and subtract markdowns. Now, there are no markups and markdowns in the cost area because they only have to do with selling price. So take your beginning inventory plus your purchases at cost, add your freight in on the purchases. That's part of the cost of the inventory, subtract your purchase returns. So the total cost of everything you could have sold is $780. Now, if we did sell everything, what would have been the retail amount we would have received or the revenue? Beginning retail of inventory 125, purchases we originally priced out at 1,006. We did return some of those. They had a $2 retail value. We marked up some prices 4, and we marked down some prices 8. So we subtract those. So under the average cost method, we take the retail value after subtracting markdowns. Take the 780 cost divided by 1125. So for purposes of determining ending inventory, we will use 69.33 as our cost to retail percentage. Because remember what we're doing here. We know the total retail value of everything we could have sold. And a quick check or a quick check of all of our sales, we could say, well, how much do we actually sell? What was the selling price of everything we sold? $916. So we can come up with an ending inventory, but that's the selling price. We don't keep track of inventory in our records at its selling price, but its cost. So if we take 69.33% of the 209, that will give us our cost of ending inventory under average cost. Now, what if it was the conventional or lower of cost or market method? Well, when we're determining, we still set everything up the same, total cost, total retail. But when we are coming up with our ratio, don't subtract markdowns. So instead of using 1125 as your denominator, it'll be 1133. We still subtract markdowns overall because they did occur, but don't subtract them when determining your ratio. So if we sold 916 of the 1125, there's $209 of inventory left at its selling price or its retail value. Convert that under the conventional method by taking 68.84% of that 209. So under the lower cost or market, it would be valued at 143.88. Okay, so again, the retail method, you always approach it the same, but when you're coming up with your cost to retail percentages, the method you're using will determine if items are included or excluded from determining that cost to retail percentage. Okay, so please let me know if you have any questions. And that's